Oh my goodness. S&P 500's up almost 18%. NASDAQ 36%. Facebook 151, 157 from Tesla, 221 from Nvidia. Oh my gosh, there is no way that I'm going to be able to find 5 dividend stocks that are at great values that you can buy and hold forever. Well, if you've got that mindset, you're wrong. I dug through the depths and found 5 dividend stocks that you can buy and hold forever. I am Tortoise Investing. This is a channel. I do 5 dividend stocks you can buy and hold forever videos. I got a new randomizer picking my stock series that I've started up through Charles Schwab. And if any of that interests you and you want to join me on this ride, hit that like and subscribe button. Super free, super easy to do, and I greatly appreciate it. Without further ado, the 5 dividend stocks you can buy and hold forever that we're going to be taking a look at: United Healthcare Group, Tractor Supply, Morgan Stanley, Keurig Dr Pepper, and NextEra Energy. All of these are market-beating dividend stocks right now that you can buy that are still on sale. We'll say United Health Group, I believe their earnings call is tomorrow, which will be today because I'm going to be releasing this on Friday. So see how that goes. This may even go down a little bit further. Might be even better opportunity to buy in. None of this is financial advice, entertainment, and educational purposes only. Without further ado, let's go ahead and take a look at United Healthcare Group. Free adjusted cash flow, a free cash flow yield of 7.95%, dividend yield of 1.48%, and a payout ratio of 30%. All very nice. They were off a recent high here. It looks like they hit right at 530. Now they're down to 447. That is down about $90. And like I said, their earnings is going to be coming out. If their earnings is a little rough, maybe this is going to drop even more and might be an even better buying opportunity. Now, the revenue over the last 10 years has been increased at a rate of 11.35%. The free cash flow over the last 10 years increased at a rate of 14.45%, and this is going to be right in line with their dividend increases. EPS been increasing as well, 14.75%, and that dividend yield has been increased over the last 10 years at 20.98%. Ridiculous. This is what you call a compounder. You let this ride, you reinvest the dividends, and just enjoy. Now, they do have some debt at $54 billion. Their EBITDA is $29.8 billion. No issues there. I don't like there to be 3 times more. I don't like the debt to be more than 3 times its EBITDA. So at 29, it's the debt is right at 2 times. So not an issue there. Now, if this right here is 54, if this EBITDA was lower, let's say like 15, would be an issue, but it's not. I like it. I like United Healthcare Group. I do wish they would do more share buybacks. That would help with a lot of their like ratio issues. Like their share outstanding's been flat, and as you can see, capital employed has been flat. I want to see some share buybacks, and I want to see this capital employed, return on capital employed, go up. But still, right at 18%, not really anything to complain about. It's just I like it to be growing, but still a strong healthcare stock nonetheless. Next up, Tractor Supply for just free cash flow yield of 1.86%, a dividend yield of 1.85%, and a payout ratio of 39%. Again, right there where you want to see it. This was off a recent high of through $250 down to $216. So a nice little discount off of its recent high. Let's take a look at the revenue. Revenue has been increased at a rate of 11.78%. Free cash flow has been increased at a rate of 9.98% over the last 10 years. Let's take a look at that EPS. EPS has been increased at a rate of 17.5%. Very nice over the last 10 years. And the dividend's been increased at a rate of 23% over the last 10 years. You got a really big hike right here that's probably throwing the averages off a little bit. But more than less, you can expect around 10 to 15% from Tractor Supply. I would like to see more of these, don't get me wrong. They do have some debt. They have $814 million in debt. Their EBITDA is over $1.7 billion. No issues there whatsoever. Debt is not an issue with this company. They do not have a lot of it. Now, when it comes to share buybacks, they are buying back their shares slowly but surely. Over the last 5 years, they rated 2.64%, which is very nice. And their capital employed in 2019 was 18.39. And as you can see here, as of 2022, 23.45. 47. It is slowly growing. So very nice. Very nice. I like Tractor Supply a lot. Next up, Morgan Stanley, one of the too big to fail banks that has dividend yield of 3.65%, payout ratio of 54%. So very nice. They did announce, I think, a $20 billion share buyback plan. Don't see the article thing here. So they announced a share buyback plan, which you love to see your banks do. Again, I am a sucker for share buybacks when companies do it. I love it. Over the last 10 years, revenue has been increasing at a rate of 7.49%. Their free cash flow, I will say, is kind of all over the place. Some years it's negative, some years it's positive. But this is with a lot of banks, I've realized. A lot of banks are like that, which is fine. EPS has been increasing at a rate of 14.54%. I'm just going to go with that over the last 5 years. They did have that negative year back in 2009, financial crisis. So let's see here. Dividend's been increasing at a rate of 31% over the last 10 years. Again, they have some pretty nice, right at 10% increases. 5 to 10%, and then they had this big jump here, so that's probably thrown off the average a bit, but still a great little compounder nonetheless. They have $241 billion in debt. Their EBITDA's EBITDA's $30 billion. But with banks, banks carry quite a bit of debt, but they've got $128 billion in cash, so not an issue there. That is not a red flag to me. Again, they announced that they're going to be doing, they announced a $20 billion share buyback program. So as you can see here, as of from 2021 to 2022, share count was decreased by 5.5%, and that's only going to go down with time. Their return on capital employed, not really something you look at, but I mean, it is going up. Next up, Keurig Dr Pepper. Got a adjusted free cash flow yield of 4.01%, a dividend yield of 2.55%, payout ratio a little bit on the high side at 84%, but I do believe that this is something they're going to figure out and get fixed. I still like it. It is down off its recent highs around 36-ish area. Let's look at the 1-year chart. Yeah, this thing was around $40 at one point, so maybe a good little buying opportunity if you're looking for a beverage company. It's not Coke or Pepsi. I feel like their valuations are very, very high. So revenue, let's take a look at revenue here over the last 10 years. Been increasing at a rate of 8.9%. Very nice. Free cash flow yield's been increasing at a rate of 25.28%. They have a lot of free cash on hand. I love it. EPS, I think they did a stock split back in 2018, or they sold off a portion of it. I'm not 100% sure. It's the reason this big dip is here. But yeah, it was slowly going up, and then last year, 2022, a lot of companies had a bit of a hiccup last year as well as in 2020, because last year was a technical recession, 2 negative quarters of GDP growth. So when it comes to their debt, they got $9.46 billion in debt. Their EBITDA is $3.48 billion. Times this by 3, and it is more than their debt, so not an issue. And when it comes to the dividend, oh my God, it's so tiny. I don't know why it's so tiny. They've been increasing their dividend at a rate around 6% every year, so not too bad. Again, a nice little compounder. It's got a nice little 2.55% dividend. So yeah, capital employed is a little low, but again, it was doing very well. And then in 2018, like I said, I think they had a stock split or something occur, or they sold off something, and it caused the drop. But nonetheless, Keurig Dr Pepper, I like this company long term. I like what their financial sheets looks like. They got their thing, they got everything sorted out, figured out. They got a bunch of free cash flow on hand, and the revenue's growing. So very nice. Next up, NextEra Energy, one of the very, very few utility companies that I like. They are in Florida, I do believe. They have said that they're going to be growing their EPS at a rate, I think, of like 8%, 8 to 10% over the next couple of years, and they're going to try to keep that in line with their dividend increases. And now when it comes to revenue has been increasing slowly but surely, about 4% a year over the last 10 years. Utility companies carry a lot of debt, so that's just something to expect. This is always going to be going up with 99% of your utility companies. Now, the dividend's been increased at a rate of 10.99% over the last 10 years, so very nice. Again, another strong compounder. And the thing with all of these stocks today, every one of these over the last 10 years have been beating the market. They've beaten the market over the last 10 years. So it comes to show you, it doesn't matter if things are up 220%, 157%, 151%. The index is up 36% or 17.9%. There are still opportunities out there for you to buy and still opportunities out there for you to make the most out of your money. You just got to know where to look. But yeah, that's everything I got for you today. I hope you enjoyed that. And as always, make sure to hit that like and subscribe button for more. See yous.